In a major boost to revive the flagging animal spirits and position India as one of the most attractive business destinations, the Government of India has announced a slew of measures to pump prime the economy. Let's do a three-point analysis of the impact of reduced corporate rates on broad sectors of the economy and on the equity markets. 1. How did the equity markets react to the announcement? Well, the Sensex and the Nifty posted their biggest single-day gains in 10 years. The Nifty Bank and Mid-Cap Index posted their biggest ever one-day gains as well. Now, tax cut announcements have led to gains of about 2,000 points on the Sensex and Nifty Bank as well on September 20th. The Nifty also rose by almost 600 points on September 20th. Now, investors' wealth rose by nearly 7 lakh crore rupees on BSE, and as many as 40 stocks on the BSE rose by more than 10%. Another big announcement was the rollback of enhanced surcharge on capital gains for foreign portfolio investors. Now, this again was a major sentiment booster, as since the budget, when the additional surcharge was imposed back in July, foreign institutional investors had been on a selling spree, and the rollback will revive the investors' sentiment. 2. Which sectors of the economy will be benefited the most? Well, Motilal Oswal, CMD of Motilal Oswal Financial Services, says that this is a positive for all companies as tax rate goes down for companies from 300 to 1,000 basis points. Also, slashing of corporate rates could move corporate earnings up by as much as 8 to 9%. Now, top global brokerage firms believe FMCG stocks like Britannia, Colgate, ITC, United Breweries and HUL, which gained more than 6% today, would benefit significantly. However, Marico and Dabur India fell more than 1% as brokerages believe that they do not benefit from the lower corporate taxes. Kotak institutional investors, they also believe that top corporate tax rate cut will definitely boost domestic manufacturing in autos, banks, also consumer staples will see large earnings upgrades from here on. While Macquarie recommends that adding domestic cyclicals like banks, industrials and also autos to their portfolio, and their top large capital picks are also HDFC Bank, L&T and Maruti. Now, Jefferies believes that the biggest beneficiaries of corporate tax rates will be Asian Paints and Avenue Supermart. And CLSA, in its India strategy, has reported that the winners of this move would be capex plays like ICICI Bank, Axis Bank, L&T and also Adani Ports. 3. Where are the markets headed from here then? Well, markets are up sharply even today, crossing the crucial levels of 39,000 on the Sensex and 11,600 on the Nifty on the back of sharp cut in corporate taxes, rollback of surcharge on capital gains for FPIs, and also the GST relief to the hospitality sector. Now, brokerage houses believe that equity markets would rejoice as the multi-year cycle of earnings downgrade will finally come to an end. A significant valuation re-rating will follow as the markets would start building in a virtuous cycle of upgrade in the earnings trajectory over the medium term, due to both tax savings as also the boost in revenues due to the perk up in aggregate demand. The engine of domestic consumption will also fire first, followed by the investment engine on the back of corporates regaining their mojo. Now, global brokerage houses have also revised the index targets upward as they see more announcements to further pump the economy going forward as well. Now, Nomura has raised March 2020 Nifty target to 12,545, whereas Morgan Stanley says green shoots are in the offing, and they've also raised the Sensex target to 45,000 by June 2020. Goldman Sachs, on the other hand, has raised Nifty 50 target to 13,000 from 12,500 already.